Blog Talk Radio.
It is Thursday morning, the day after the first of the great debates between Mr. Obama and Mr. Romney. And today we're talking about the New York Times article about Mr. Romney's offshore tax planning and how it has enhanced his wealth. The goal is to let you enhance your wealth. Now, my co-host, Ken Burish, a very famous criminal tax attorney, unfortunately had to do some criminal tax attorney work this morning. He's going to join us in the next episode, and his part of this episode is the second part. My part, Ken and I kind of thought about this as the good, the bad, and the ugly. The good being Mitt Romney, legal and very wealth creating. The bad is kind of a bad audit. The ugly is when you go to jail. And Ken has a great deal of experience with bad and ugly. With my experience, it is the good. So, since I'm here alone, many of you know that part of tax planning for the future is using smart equipment, smart robots, using 3D printers. So I am working today with my robot, and I'm going to have my robot read the first part of the New York Times article to us. Can you go ahead and read that?
Brian, sure, I can. Buried deep in the tax returns released by the Romney presidential campaign are references to dozens of offshore holdings with names like Ursa Funding Luxembourg SRL and Sanquity Credit Opportunities Investors Offshore IV, based in the Cayman Islands. Mr. Romney, responding to opponents' barbs about his use of overseas tax havens, has offered a narrow defense, saying only that the investments, many made through the private equity firm he founded, AIM Capital, have yielded him odd $1 of reduction in taxes. A review of thousands of pages of financial documents and interviews with tax lawyers found that in some cases, the offshore arrangements enabled his individual retirement account to avoid taxes on its investments and may well have reduced Mr. Romney's personal income tax bills. But perhaps a more significant impact of Mr. Romney's offshore investments has been on the profit side of the ledger in the way Bain tax avoidance strategies have enhanced his income. Some of the offshore entities enabled Bain-owned companies to sidestep certain taxes, increasing returns for Mr. Romney and other investors. Others helped Bain attract foreign investors and non-profit institutions by insulating them from taxes, again augmenting Mr. Romney's bottom line, since he shared in management fees based on the size of each Bain fund.
Now, there's a lot of great wealth features in that 1 minute part of the article read by my friend Rob the Robot. And I want to go towards the last part first, because the whole point of tax talk is not saving taxes. That's part of it, of course. But it's really having a tax strategy that allows the business or the investor to create more wealth. And let me kind of give you an example. When people cheat on their taxes, and some people really cheat and break the law, they cannot create wealth because they're in the dark. They're hiding. They cannot just do any transaction. They're afraid of somebody finding out. Maybe an office manager turning them in or disgruntled employee. It restricts them. Mr. Romney, on the other hand, follows the law, has a great tax team, and follows the black and white part of the tax law. And his tax planning is black and white. It's not even gray. It is perfect tax planning. We're going to get to that in a second. In creating the wealth, what the article pointed out, that by having a Cayman company, his company, which is an investment management company, can attract foreign investors. And this is why our IRS has scared not only Americans, but has scared foreign investors. the zealous approach towards the Swiss, while it may make the commissioner feel very good, what it says to the rest of the world is do not put money in America. You are going to be treated criminally. And our laws are so complex that, unlike laws in other countries, the laws themselves scare away the foreign investors because they do not know what is a crime in this country, what isn't a crime, when they're going to be hit with tax penalties. So if a business wants to joint venture or bring in foreign investors, one must always use a foreign corporation. They want the corporation to be in a jurisdiction where the tax laws are simple. There's nothing more simple than no tax laws. That is simple as it gets. Grand Cayman is one of those countries. It's situated in a good time zone. It has a great airport, direct flights from the UK to Grand Cayman, great hotels. It's the kind of place that attracts businessmen. Now, the other part that was interesting to me in the New York Times opening paragraphs was the precise explanation of the Romney tax strategy. It's not complicated. So let me kind of give you 3 items that he used that you can use too. They're very, very simple. The first item is that Mr. Romney had foreign corporations that are considered, this is a tax term, controlled foreign corporations. That means investment income passes through to the U.S. shareholders. So now you're probably wondering, how did he avoid the tax? Well, when these laws were drafted in 1960 under the Kennedy administration, most of the international work was done by publicly traded companies. So they designed the laws to fit their needs. These laws are ancient. They're half a century old. Under these laws, it is easy. And this is how easy it is. There's 2 easy ways. One easy way is that the investment income that passes through to the U.S. shareholder only passes through to shareholders with voting stock. Corporations can have common stock that votes and common stocks that does not vote. Both stocks share in the equity and increase value of a corporation. One stock has a right to elect the board of directors, one does not. But there's other simple ways. Any American can own up to 10%, not quite, 9.9% of the voting common stock of a controlled foreign corporation and be considered a foreign person. That's right. If you own 9% of a controlled foreign corporation, your stock ownership is not counted. So to make it simple, if you had 11 people each owning 9%, or whatever the ratio is, 9.1, and they're all Americans, they all lived in the United States, that foreign corporation, while it's owned solely by Americans, all of them have voting common stock. That foreign corporation is not a controlled foreign corporation, and the investment income is not reported on the tax returns of Americans. Now, those are 2 simple ways. Mitt Romney's tax planning used another simple way, which is not talked about at seminars. Now, when you go to international tax seminars, I can assure you, you are not going to learn how to do tax planning. Nobody's giving away the secrets. Even these that we have on this show will never be given away at a seminar. People make their money using these seminars. So I'm going to ask my friend Rob, the robot, to read some more about his structure for me, because that structure is important. Listen here.
Yes. You mean the retirement plan structure. A variety of main funds in the Romneys' portfolio have controlling stakes in foreign companies. Had those funds been set up in the United States, the Romneys and other American investors would probably have been subject to certain federal taxes for their ownership of controlled foreign corporations. Setting up the funds in the Caymans allowed them to avoid those taxes.
And this is really simple. The Times article points out 2 things. One, that Romney owned his voting common stock in his retirement plan. As we know, retirement plans, a qualified retirement plans, a 401k plan, a corporate profit sharing plan, are tax exempt. They do not pay taxes. They can own all the shares of a controlled foreign corporation, including the voting shares, and pay no tax. Since this is Mr. Romney's retirement plan, he gets to direct the trustee on how to vote the shares. Now, this does not work well, I do not think, if the retirement plan is an IRA. It's a custodial account. There's a unique case that Ken Burish's firm tried on somebody using a IRA to own shares of a S corporation. Didn't work well. So if you're going to use a retirement plan, you need one that's not an IRA. Corporate retirement plans and actually retirement plans for sole proprietorships and LLCs always have a trustee, and it's a trust account. Now, who's the trustee? The trustee is you. The owner of the plan, the owner of the business is almost always the trustee. Big firms may have a corporate trustee just because there's so much paperwork, but small businesses almost always have the business owner as the trustee. Excuse me, a little cough today. Okay, the nonprofits. A lot of nonprofits were investing in these plans. The reason is that the Cayman business can be more variety, do more joint venture agreements, and make more profits than just a passive investment that most charities can invest in through the U.S. stock market. So this allows the charity to diversify its portfolio in getting into some higher risk investments. Higher risk means, maybe higher returns, but a good portfolio has a wide range of risks. So to kind of summarize, the tax planning is easy for any of you to do. You either look at the stock ownership, less than 10%. You look at the voting common stock to be in a retirement plan, or if you have your own nonprofit, many people have what's called private foundations. They are IRS exempt. The IRS will actually give you a guarantee, a ruling, stating that you're tax exempt. And those are the easy ways to save taxes. Now, going to get into a little bit of boring detail here as Rob the Robot reads about the documents that the New York Times came across. This is going to take about 2 minutes, so kind of hang on. It's a little tedious, but I want you to understand how easy this is and what some of the tax advisors who the New York Times interviewed said about the documents and the tax planning.
Oh, yes. Let me find them. Okay. The documents, which include confidential Bain prospectuses and foreign regulatory filings, many previously unreported, illustrate how these tax avoidance strategies are woven into the fabric of Bain deal-making. While hardly a novel concept and not unique to Bain, the inevitable result is that elite investors like Mr. Romney are able to increase their fortunes in ways unavailable to most taxpayers. Private equity fund managers have a responsibility to their investors to maximize their investors' returns, and part of that responsibility involves minimizing taxes, said David S. Miller, a tax partner at Cadwalader, Wickersham and Taft. Many of the details of the Romneys' wealth, estimated at $250 million, remain hidden, partly because Mr. Romney has released only the last 2 years of his tax returns. Those returns show an effective tax rate of about 14%, because most of the earnings came from investments and are taxed at 15%, significantly lower than rates on ordinary income. In a statement, the Romney campaign said, "Governor and Mrs. Romney have scrupulously followed the tax laws and have paid 100% of what they owed." The sophisticated tax strategies of Bain and other private equity firms begin with the basic architecture of their funds. Though headquartered in Boston, Bain and its credit affiliate, Sanquity Advisors, have set up at least 137 entities in the Caymans, using local lawyers and others who provide an island's address for paperwork purposes. Contrary to veiled assertions by some of Mr. Romney's Democratic foes, hiding assets from the Internal Revenue Service as probably not part of their rationale. Some might still assail the arrangements as tax dodges. Others, however, would say they are simply efforts to make bean funds more tax efficient. Who can call these loopholes? Mr. Miller said they really just inadvertent consequences of an extremely complicated system. To navigate that system, Bain said in a statement, like virtually all global asset managers, we use widely accepted, fully legal and recognized structures so that investors may receive predictable tax treatment on investment gains for their constituents.
So what was important because it's wrong, is hiding assets from the IRS. In the Romney structure, with the retirement plan owning shares of the company, I'd assume that more than 9% was owned by the retirement plan because he wants the wealth in there and he wants the voting control of the voting common stock. A controlled foreign corporation does not hide from the IRS. Each year, it files an extensive financial statement on a form. The form number is 5471. If you'd like to pull it up on the internet, that's form 5471. It's a very complete statement. It has currency, exchange, gains and loss. It's done under generally accepted accounting principles. It tells the IRS everything that's going on. Nothing is being hidden from the IRS. And great tax planning means you do not hide. Hiding is going to restrict your ability to create wealth. And it's really important that you are transparent, because when you want to do a transaction, you don't want anybody to be able to blackmail you because you're hiding from the government. You want to be able to move forward and create a tremendous wealth. So now, how do you do this? And how do you do this in a way that you know is going to be tax compliant, that you're not going to be facing the bad or the ugly, as Ken Burrish will be talking about next week? Well, the way that my firm does it is every client goes to the IRS and gets a tax guarantee. The legal term for this is a private letter ruling. It is a contract between the IRS and you as a taxpayer in which you lay out your business plan, your business transaction. The IRS reviews it with your CPA and writes back to you a contract stating exactly how you're going to be taxed or not taxed in this case, what form you're going to file, and it's going to be the form 5471. And this is a guarantee that you are tax compliant. With this, you do not have to worry that your CPA has done something wrong or your attorney has done something wrong. So this is Tax Talk today, and I look forward to being on with Ken Burrish next week. I hope you all have a great day. You can always call me at 949-939-3414 with any questions you may have, or just find me on the web by typing in my name, Brian Dooley, Dooley, CPA, and I'm sure I will pop up in the first part of any Google search. Thank you for listening, and I wish you all a great day and great tax planning.